We just have a quick question here from Sergey asking if the S&P 500 is inversely correlated with the dollar index. So thanks for the question, Sergey. The answer to this question is both yes and no at the same time, depending on what type of environment the overall market is in. According to historical studies over the last 2 decades, you'll see that the S&P 500 and the dollar index is actually a positive correlation with a correlation coefficient of about 0.38. So that means about 40% of the time, the moves can be associated with each other. So there's a positive correlation, but it's not a whole lot, to be honest. Now, the simple reason why this should be the case is in terms of foreign investment, right? So if there's an increase in foreign investment, that usually driven by demand for US stocks, for example, you will normally see an increase in the dollar as well. So if somebody wants to buy US stocks from the outside, they need to actually exchange their currency, their local one, for US dollars in order to buy the US stocks they want to buy. So in that sense, any big inflows into US stock markets from a foreign investor point of view should see an increase in the demand for dollars, and thus obviously see the dollar rise alongside the stock market. Now, as we said, according to historical data, there is a positive correlation, but there are definitely times when a clear negative or inverse correlation can be seen with the dollar and something like the S&P 500. And a very good example of this is times when there is immense global uncertainty. So times when the global economy is going through a tough time, a tough patch, and international trade slows down, then you usually see the dollar increase in both safe haven appeal and demand appeal, as the slowdown in international trade causes less US dollar liquidity in the system. Now, if we quickly take a look at the dollar index versus the S&P 500, so here in the blue we have the S&P 500, and in gold we have the dollar index. Now, if we just look at this from the very most recent price moves, we can see a very strong inverse correlation between the two. And this has mainly been driven by the US dollar safe haven appeal during this immense economic uncertainty that we're going through now after the coronavirus. Now, because the US dollar trades as a safe haven in these times, we've seen the US dollar basically moving in opposite direction to stocks, or rather inversely to risk assets, which causes a very strong inverse correlation between the dollar and stock indexes. So, for example, risk on sentiment sees strength in indexes. And because the dollar is trading as a safe haven with that safe haven appeal, you'll see the dollar sell off alongside other safe havens like the Japanese yen and the Swiss franc when we have those risk on tones, and of course the vice versa when we have a risk off tone. But by looking through the chart, let's just go to the daily, and there's a couple of examples that I want to show you from prior time periods that's important to note. So going back on the chart, if we have a look at the 2008 and 2009 global financial crisis, we know that was a time when the dollar also traded as a safe haven. There was that safe haven appeal. And there you can also see that inverse correlation. So upside in the dollar and then downside in stock prices. But then moving on to something like 2014 and 2015, we saw a very big surge in the US dollar alongside an upside in S&P as well. And the dollar's gains here were mostly driven by the Fed starting to taper back their QE programs, which caused a big divergence between the rest of the world's major currencies. And that was basically exacerbated. The strength was exacerbated in the dollar from the euro side as well, because we must remember that the biggest component for the dollar index is the euro. And the euro saw immense downside pressure from 2014 and 15 when the ECB adopted their whatever it takes approach with regards to QE, which basically sent the euro tanking and saw additional strength coming into the US dollar. Now, then we can also see the dollar actually again moving inversely to the S&P during the end of 2016 and during 2017. Now, what happened here was we had the global synchronized recovery, or global synchronized reflation, where the world started to show real signs of synchronized recovery and growth, especially in other places outside the US like China and the Eurozone, where things were really firing on all cylinders during that time. And we know that the dollar doesn't like reflation, so that saw a lot of dollar downside again while stocks were actually moving up. So there are times when we have the correlation, a positive correlation, and there will be times when we have that inverse correlation. But it will mainly be due to idiosyncratic factors that doesn't really have anything to do with the with the correlation between the two itself, but more the overall factors driving the overall markets, which can obviously affect the dollar from a safe haven appeal, and then obviously affect it again from a reflation narrative point of view. So I hope that helps, Sergey. Any other questions, don't hesitate to let us know.